Hello, GoldSilver family. Alan Hibbert here with another video, and this time I want to go through some of the trends we're seeing in the long term and the medium term in gold and in other markets. And as a jumping off point, I wanted to use the In Gold We Trust report recently released by Ronnie Stoffele and Incrementum. And I saw a great Twitter thread by Tur de Meester covering some of those charts, and I want to go through those with you today. So let's take a look here. The new gold playbook, as I said, by Ronnie Stoffele and Marc Faber at Incrementum. And there is a Twitter thread here, but I'm jumping around and I'm leaving a lot of these tweets out. So if you like it and you want to learn more, go check out the full Twitter thread and the full report. It is free. So first of all, Incrementum just dropped their monster gold report. As always, it is a treasure trove of global macro charts. It is remarkably friendly to Bitcoin too. Here's a selection. So I skipped the Bitcoin charts for today, but I've got some other good ones I think you're going to like. So here we have global central bank gold purchases in tons from 2010 to 2024. And you can see two different tiers. The average of global central bank gold purchases before the Ukraine war and after. And it jumps up by more than a factor of 2. And Tur de Meester says, clearly the invasion of Ukraine and the subsequent financial sanctions marked a new era for central banks who are now buying gold much more aggressively. So certainly this is a sign of global instability, possibly one war leading to more wars or a bigger war. What else do we have here? Well, we have the top 10 gold buyers since 2010 in tons, and Russia is the world's most aggressive government gold buyer, with over 1,600 tons purchased since 2010. And the number 2 gold buyers are Russia and China. Russia and China. And I don't see the United States on this list. So very interesting. Russia and China buying gold, not just a lot, but more than any other country. And the United States is nowhere to be found. Very interesting shift in power globally. What else are Russia and China doing? Well, Russia has just confiscated 800 million euros from Deutsche Bank, UniCredit, and Commerzbank. And this is on the heels of a sort of a reciprocal confiscation of Russian funds. So after 2 years of being on the receiving end of a weaponized global reserve currency, getting booted from SWIFT, countless toothless sanctions, and watching some $350 billion of its assets be frozen and soon confiscated, Moscow has had enough. And over the weekend, the Financial Times reported that a St. Petersburg court seized around 800 million euros worth of assets belonging to 3 Western banks. So again, tit for tat escalation. You know, at some point it's got to stop. At some point it has to stop. We will see what happens. What is China doing? Well, China is selling treasuries and US agency debt at a record level. So you can see here, this, by the way, does not come from the Incrementum report. This is a separate chart here. China just dumped the largest amount of US treasuries and agency debt in history. Probably fine. So you can see the black line, when it's above the 0 line, that's net purchases of US debt. And when it's below the 0 line, those are net sales. And you can see that we're below the line more so than we ever have been. So China is dumping US debt. What about the other central banks? Well, this here is a chart back from the Incrementum report of US debt held by foreign central banks as a percentage of total debt. Let's start with that. That's the line here. So this is debt held by foreign central banks as a percentage of total debt. And you can see that it peaked around 35% of US debt was held by foreign central banks, but now they're dumping US debt. So it's not just China, right? It's countries all over the world. And now we're down below 25%, headed towards 20%. So basically the other countries in the world don't want promises from the United States. It's that simple. And they're trying to get rid of their dollar relationships. So that's half of this chart. The other half is central bank gold holdings as a percentage of their currency reserves. So that's the gold mountain graph here. And you can see that it was declining since the 1980s, but around 2013, 2014, 2015, it started to pick up again. And so this looks like a trend that has shifted and changed directions. I would expect central banks to own more gold as a percentage of their reserves for the next couple decades. So we will see. Zooming out, looking not just at gold, but gold, silver, commodities in general, what is the general trend? Well, there's a great chart here. Another way to describe a commodity supercycle is a period where fraudulent paper promises evaporate and the markets focus on the real assets that remain. So I think this is part of the trend we're seeing here. You can see these are commodity prices going back over 100 years, 1915. So generally, there's a period of tremendous commodity growth, bull market, and then a bear market, and then a bull market, and then a bear market. And this trend repeats, and it's not unique to commodities, of course. But where are we now? Well, it seems like we are into a bull market. But if you notice, look at these green lines. Each one, okay, exceeds the height of the previous green line. So in other words, each bull market breaks the high of the previous bull market. So we keep going higher and higher and higher. It seems unlikely that we would stop right here because we haven't taken out the old high. So I could see us going, based on this chart, another doubling easily. Keep in mind, this is a log chart. So every fixed distance here represents a doubling. So another doubling is a pretty low estimate. I mean, it could be a factor of 4 or more. So this is commodities in general. I would expect gold and silver to go along for the ride, possibly even to be in the driver's seat. Speaking of commodities, this chart has been the most shared chart of the In Gold We Trust report. It expresses commodities in terms of the US stock market, suggesting that a new commodity supercycle is highly overdue. So what we have here is the S&P GSCI Total Return Index. This is a commodity index, okay, the Goldman Sachs Commodity Index, divided by the S&P 500. So again, this expresses the price of commodities in terms of the US stock market. So you can see that where we are right now is at basically record low prices. I mean, early 2020, it was slightly lower, but this whole period of the last 4 to 5 years has been the lowest that commodities have been priced relative to the stock market in the last 50 years. So it is possible that we achieve, some peak like we experienced in the past. And in order for that to happen, we would have to raise the price of commodities to meet the median and then exceed the median up to these levels. So right now we're down a ratio of about 1. We could go up to 4 to hit the median, could go up to 8 to set a new record. So this suggests that the prices of commodities, or at least the commodity index here, could go up by a factor of 8 to 10 relative to stocks in the next few years. Speaking of the stock market, again, another chart from outside that report, the top 10% of stocks by size versus the entire US stock market. So this here basically represents how top heavy the stock market is. This is the market cap concentration among the top 10% largest US stocks. And you can see that as a median, we're under 65%. Right now, we're up near 75%. We've only been this top heavy one time in history, and that was in basically the Great Depression era. So never forget, this time it's different. Maybe, maybe not. Well, what about treasuries? Well, here is the US 10-year Treasury annualized real returns in dollars since 1900. Okay, so this is going back a long time, basically 125 years. Tur de Meester says, no way that long-dated bonds can beat inflation anymore. Proof of stake always fails in the long run. Proof of stake versus proof of work. So interesting distinction. We'll save that for another video. I think most of you guys know what that is. But anyways, what Incrementum is highlighting here is that US 10-year returns are declining for 35 years. Absolutely plummeting, going negative. So when you adjust it for inflation, the investment goes backwards. So it seems like a lot of investors are waking up to this. We just showed how global central banks are dumping US treasuries. Plenty of other investors are too. Well, at least inflation is low, right? I don't know about that. So inflation in the last 40 years was exceptionally low for a fiat world. It was achieved by the deflationary force of the tech boom, globalization, the rise of China, sales of gold reserves, which we saw earlier, and other national assets. That period of moderation is now distinctly over. So this year is the Great Moderation, lasting about 40 years. And it seems like we are now out of that period. We got a first wave of inflation. We may have more, and that's actually what I want to highlight next. Basically, this is an anomaly, this last period. And what we tend to see is something like what happened in the 70s. Inflation comes in waves, and history rhymes. Here's the US CPI inflation today compared to the 1970s. So I was actually going to put a chart like this together because I saw a chart from Tavi Costa, which I showed in a recent video, where he showed the waves, the inflation waves of the 1970s. And I wanted to overlay the current inflation over that, and it turns out that incrementum did it for me. So I decided to use this chart. But what's interesting is that they've overlaid today's inflation, basically the gold line, over here. And they've got two waves of inflation here. Okay. And the chart that Tavi had says that we've only had one wave of inflation so far. Okay. So this is the chart I showed from Tavi in a previous video. Basically, Tavi is saying that we've had one wave of inflation with two more to follow if we mirror the 1970s. And going back, incrementum says we've already had two waves of inflation with only one more to follow. So I'm not sure where it would make sense to line this up. Have we only had one wave so far, or have we had two? And looking forward, are we expected to get one or two waves of inflation? I'm not sure. I would tend to lean towards what Tavi has here. I would tend to think that we're going to get two more waves of inflation. But I think all three of us can agree that at least one more wave is coming. And investors are definitely getting prepared. And here is the US consumer in one chart. Credit card debt, record high. Personal savings rate, record low. Here is, so the, let's start with the red line. The credit card debt. You can see it was rising leading up to 2020. And when COVID hit, it seems like everyone hunkered down, savings rate green shot up. Everyone paid down their debt. And then in the so-called recovery, credit card debt took off like a rocket, even faster than it was rising before. That's very telling for that rate to be a faster rate of increase than the previous rate. We're also at levels we've never been at before. Similarly, the green line, savings rate spiked when COVID hit, stayed relatively high throughout that crisis. And then in the so-called recovery, quote unquote, savings rate dropped even lower than it was before. So not much of a recovery. And this is basically what people are dealing with. This is the average US consumer in one chart. And I also want to remind you how few people own gold. Family offices hold less than 1% in gold. You can barely find it here. It's one of these tiny little slivers. And what people are actually holding, equities, fixed income, private equity, real estate, all those traditional assets. There is a tremendous, tremendous opportunity for this asset mix to change over time, for the small pieces to start taking over the portfolio and to see these large pieces shrinking in size. That is what I expect to happen moving forward. And this whole combination of factors that we talked about today is actually why Ronnie Stoefferle, one of the co-authors of the report we just looked at, why he confirms his long-term gold price target of $4,821 by the end of the decade. So about 5 or 6 years. So all of those reasons we talked about, from the central bank to the commodities being undervalued relative to the stock market, to US Treasury promises being worthless and not being able to keep up with inflation, to the underallocation of the individual consumers and investors to gold, it looks very bullish for gold. And I want to leave you guys with this. Inflation, what inflation? A package of ground beef costs the same as it did last month. It's just now that they're bite size. So thank you guys for watching. I hope you enjoyed this. If you want to learn more, go check out the In Gold We Trust report with Ronnie Stoefferle. It's free. And I'll see you guys in the next video.